All right, real quick, we're going to go on over something new. A new phrase that I coined. I'm going to try to make this video real quick. Theta Trap. So what is a Theta Trap? So for you to have a Theta Trap, you need a few things. So one, you need price. To be in a range. Two, you need low volume. And time will take care of number three. So if you want to avoid the Theta Trap, give yourself more time on your options, on the expiration date on your option. If you're doing same day options, you know you're more prone to get caught in the Theta Trap. Now let's illustrate this. So just say you got price. It's moving. It's doing its thing. Creating lower lows. Okay. Higher, little higher highs a little bit. Get some price action going. Get a little more wick. Let's see. Okay. Do that. Okay, bam. Now, this is the current price action. So you got higher highs, higher lows, higher highs, higher lows. So that creates the uptrend. And right here you got higher high, higher lows, uptrend. Kind of got it, you even got a downtrend right here. Bam. Now, what do we have here? This price action is stuck in this range right here. So this is what I would call, well, I would make lines for. So some people call it consolidation. Some people call it ranging. So from the top up here to down here, this is pretty much a price range. So just say this down here is $10. And up here is $12. So pretty much this price action from here just ranging between $10 and $12. Now, sometimes you have ranges where it's 50 cents to $1. So just say this was actually $11. $11. So 10 to $11. Now, as time goes and you get stuck in a range, you can get stopped out a lot of times between here and there. Now, what makes this? So that would be a trap. Pretty much you trapped in here. If you stuck in this range and you looking to break out for your option to actually start getting a profit, you needed to break up or break down. Just say you bought some contracts and it's within here, within this price range, between 10 and 11. So for it to make money, you needed to break out past 11 to get into profit, or if you got a put option. So 11, if you got a call option, you wanted to go 11 or above. If you got a put option, you wanted to, break to the downside so you can get a profit. So you pretty much trapped until it break out of here. Now, just say the volume of the day of the trading session is so low that it's not enough to push up. So volume. If you ever put your cursor on each candlestick, they have a number representing them. And that number, if you look on a volume chart, let me pull back a little bit. So if you ever seen at the bottom of like on your chart, you have like the lines for the volume, like so you got green here. Let's erase this. So volume you will have, so these kind of big moves, so you will have long volume, long volume, long volume. Now this smaller, move, but it's still kind of moving. So just say a smaller volume. This one a little longer. Now, say these smaller ones. Smaller volumes. Now we get to these. Larger volumes. Now, for the price to really move, it has to be accompanied by large volume. So if you're on, just say the 5-minute time frames, each candlestick has a number value. If you put your cursor on any one of these, it has a number that represents it. And so for the price to actually move out of this range, it's going to have a certain amount of volume. Now, until it can move out that range, it's trapped in there. So where does theta come in at? Okay, this is where theta come in at. Now, if you know about theta, then you pretty much know as time get closer to the expiration date, so each stock options would have an expiration date. So if you buy an option on December 1st and the expiration date on that is, just say, December 5th. As you get closer to the expiration date, as time moves, your theta starts to drain away. That means the value of your option is worth less. So by the time you get to the last day, expiration day, the end of the day, if your stock is out of the money. Your option is out of the money. And this is a whole nother lesson: in the money, out the money, at the money. But just for conversation purposes, we're going to leave that out right now. We're going to leave the in the money, at the money, out the money. We're going to leave that out and just say, in a nutshell, by the time expiration date hits, your option will be worth, just say nothing. It will be be worthless. It expire worthless. Just say if you don't trade it. So you get it on the first, then by the second, value's going down. By the third, it's going down more. Fourth, it's worth less. Fifth is worth a little less, and then by the end of the day, it goes down to 0. So how does that affect you if your price is in a range? If your price is stuck in a range, with low volume, so it can't break out of the range, so it's stuck in there, then as time is going, it's becoming worth less. So that right there, in a nutshell, is Theta Trap. You get trapped in a range. You have to have a range. So you get trapped in this range. Then Theta is actually killing your time and pretty much it ain't much you can do, because you either just gotta exit your play, and that's pretty much the only defense you got, because it's not breaking out. So your stuff is not moving. It's not in profit. And if you want to wait for it to get into profit, just say you want to say, okay, maybe in the next hour it's gonna get in profit. Another hour go by, it's still not in profit, it's still range. Okay, I'm gonna give it one more hour. Okay, I'm gonna get it before 3 o'clock hit. So by that time, it ain't really worth nothing. It's probably worth a couple dollars at that point. That's the Theta Trap. I hope that helped.